Very good morning, friends. So welcome back again. So we are going to start a fresh standard today. Last time we had introduction to the Indian accounting standards. I hope you made a revision as well and did the illustrations in the study material as well. Well, today is a very important base for your subject on financial reporting, because what we're going to discuss is a blend of Ind AS 1 as well as Schedule 3, Division 2, which I mentioned in the previous session. When you look at Ind AS 1, the name of the standard is called Presentation of Financial Statements. Now, I don't want to say that at the very start itself, but I can't really stop myself from saying that as well. You know, the interesting part is that there is a new standard which is on the way. In fact, a new standard has already been released, and internationally, that standard is called IFRS 18. Now, as I said, I can't really stop myself from telling you something. So I think let's begin with a note of knowledge in the morning, and then we'll start with Ind AS 1. So if you remember my discussions in the previous session, where I gave you the numbering as far as the Indian accounting standard is concerned, how they've been numbered. So I think I'd just like to quickly give you a recall. Now, when we are studying this Ind AS 1, let me just map you in terms of what I gave you in the previous session. We said that when you're looking in terms of Ind AS, we basically created Ind AS out of IFRS. So as we said, in terms of IFRS, we've got IAS standards, International Accounting Standards, and we have got IFRS. And I said the series is 1 to 1, 1 to 41, and it is 1 to 17. So these are the two series which are there in terms of IFRS. Now, when we created these Indian accounting standards in terms of Ind AS, we called IAS also as Ind AS. We called IFRS also as Ind AS. But we said this is 1 to 41, but this goes on the series 101 to 117. So what we are studying today is Ind AS 1. So when you're studying the Ind AS 1, we are basically looking at the corresponding standard, that is IAS 1. But as I said, the good news is there is a new standard which has already been released by the International Accounting Standard Board, and that is called IFRS 18. It's not yet implemented. It's not yet implemented. The new standard which has been released is called IFRS 18, and this is going to be applicable with effect from 1st January 2027. So this is going to be applicable in the international countries with effect from 1st January 2027. So we're going to see correspondingly an Ind AS 118 coming into account. So we will see in India that Ind AS 118 is going to become applicable. But what is the date when it's going to become applicable is not yet announced. Okay, now let me also tell you something interesting. You would say, why are you telling me this, sir? Because as far as the IFRS 18 is concerned, the corresponding Ind AS 118 is concerned, the standard IAS 1, the standard Ind AS 1 will get withdrawn. So the day this Ind AS 118 becomes applicable, then Ind AS 1 will get withdrawn at that particular date. But this is not going to happen soon. This is going to happen in 27. So in all probability, I guess if we consider that internationally the standard becomes applicable on 1st January 27, so we could possibly see the application of the standard on 1st April 27. Now you would say, what is the massive change which is coming in? I think it's too early to tell you the kind of massive change which is coming in. As I progress, I might give you a few insights in terms of what is the new things coming in. But there is massively going to be a change in terms of how the income statement looks like. So I think that was just a bit of a knowledge piece early in the morning as we start off a day. Okay, so coming back now to the agenda, my agenda for the day as well as for the next session is Ind AS 1, and that's called Presentation of Financial Statements. So today is going to be a very, very important session. because this session will give you a grounding work in terms of the various components of financial statements, how these financial statements look like. So I'm going to give you a lot of walkthrough in terms of the Schedule 3, blending the discussion of Ind AS 1 as well as Schedule 3. So let's begin the journey. So we are doing Ind AS 1. I'm just going to put the heading Ind AS 1, and that is called presentation. The name of the standard itself is presentation of financial statements. Presentation of financial statements. How would the financial statements be presented? The keyword is presentation and the keyword is financial statements. I guess just to remind you, when you're looking at financial statements, you already seen in the previous class that financial statements in Division 2 is supposed to be comprising of 4 documents. So I just want to put it across again. So when we said that you're looking in terms of financial statements, our focus is going to be completely in terms of Division 2. So we said the financial statements, the complete set of financial statements comprises of a total of 4 documents. So one is what we call a balance sheet. And I guess if you remember, I also gave you that there is an accompanying document which is called SOKI. That is Statement of Changes in Other Equity. So today we're also going to talk in terms of SOKI as well. We're going to talk in terms of balance sheet. We're going to talk in terms of SOKI. The second one we know is called an income statement. And the income statement has got 2 components. One is a profit and loss, and the other one which I gave you is called OCI. That's called Other Comprehensive Income. So are we going to talk in terms of OCI also? Yes, in the standard, we're going to talk in terms of other comprehensive income. So are you going to assume any kind of base on our part that we have some knowledge? Of course not. Get relaxed. I'm going to explain you things from the very scratch, and we are going to give you a good knowledge in terms of OCI and in terms of SOKI, because as the course will progress, once you go to study the other standards, this concept needs to be, a base should be clear so that you can get more clarity as you study these standards. The third one is supposed to be a cash flow statement, but we're not going to talk in terms of cash flow statement because there is a separate standard which is devoted to cash flow statement, that is Ind AS 7. So on my agenda in terms of presentation, we are not discussing a cash flow statement. My focus will be on a balance sheet. My focus would be on an income statement. And of course, the fourth element is supposed to be notes to accounts. So we're not going to discuss notes to accounts also as such, because notes to account is something which you can appreciate only after you have started making some financial statements, once you are able to put in the figures in the balance sheet and the income statement. So I'm going to start my journey to begin with in terms of balance sheet with you. Then we'll go on to the income statement, connect you to the SOKI and other components. So what I've done today, I am carrying the format of Schedule 3, Division 2 with me, and I'm going to first talk on a balance sheet. Now, my caution, friends, to you, just hear me very carefully. I will be giving you the notes as well, but hear each and every word very carefully, because I know you might see a lot of transition change as compared to the previous session. You might suddenly feel that the level has suddenly gone up. Yes, it'll go up, but trust me, you're going to get a good conceptual clarity as well. T&C apply. I hope you know what is T&C, terms and conditions applicable. But these terms and conditions is, I just need your complete attention at this time. Your eyes and ears need to be kept open, and just hear me carefully. Don't see anything extra beyond what I show you, and don't hear anything extra beyond what I tell you. So let's begin the journey and let's start talking in terms of the balance sheet. Now, I'm just going to have a look, a very basic look at the balance sheet. So I hope the visibility is there. Let me zoom it further as well. Just let me know on the chat box if you can see the balance sheet well. Just let me know if you can see it well. Yes, that's great indeed. Okay. Now, since you've all studied at the intermediate level, I know that you are aware of a balance sheet which is division 1, but our focus, as we said, is division 2. So just see what I show you, nothing extra at this stage. Just see only what I show you. Well, you can notice something absolutely interesting, that this balance sheet starts on the asset side. I know what you've done on the schedule 3, division 1, the balance sheet starts with equity and liability. But in terms of division 2, the balance sheet starts on the asset side. It doesn't make a difference at all, because at the end of the day, you've got assets and you've got equity and liability. So division 1 says equity liability followed by assets. But division 2 starts with assets and then it talks of equity liability. That is one fundamental change. I'm just showing you some few very important changes so that you transit from your intermediate to the final stage. Next, I'm not looking further on the asset side. I'm now going to have a little look on the liability side of the balance sheet as well. So I guess that's what I can zoom further so that the screen becomes completely visible to you. So just have a little look further. You can see that on the liability side, we've got equity and liability. Now, let me tell you something more at this stage. Don't worry, the notes will be documented shortly. You just need to be a keen observer and a listener at the moment. You can see in the equity, there is an equity share capital. There is an equity share capital. If you recall the balance sheet, what you did at the intermediate level, you saw in the balance sheet share capital. The word was written share capital, but now in this you can see the word is clearly written equity share capital, which I think definitely puts a question back to the mind. Sir, are you indirectly trying to tell us that there is a preference share capital and that preference share capital is no longer going to be a part of the equity share capital? You guessed it correct. Though you will learn these things more in detail when you come to the standard on financial instruments, but as of now, I can't give you a deeper logic. But you can definitely keep in mind that when we are going to consider this equity share capital, the preference share capital definitely is not a part of equity. It could be a rare circumstance where a preference share capital in the Indian scenario would become an equity in the balance sheet. The chances are 99.99% that the preference share capital is not going to become equity. So can you also tell us at this stage, just for knowledge, that if preference share capital doesn't appear out here, then exactly where is it going to appear in the balance sheet? Okay, let's make your life simple. You can see the borrowings which are appearing in the balance sheet of the company. So you're going to see that as far as the preference share capital is concerned, they would be appearing as a part of the borrowings in the balance sheet. They will be appearing as liabilities in the balance sheet. So that is the second big change. So what was the first change? That we are starting with the asset side of the balance sheet. I sometimes, tell people on a very light mood that why does the balance sheet starts from the asset side? I think it reminds me the fact, mere paas maa hai. Don't take me seriously on that and don't judge me on that. But in any case, when you look at the balance sheet and it starts from the asset side, I think that reminds me on a very filmy level. And the second big change is that as far as the preference share capital is concerned, that's no longer going to be a part of the equity, because we don't use the word share capital, we are using the word equity share capital. Now, let's have a look at another input as well. You can see as a part of the equity, there is something which is written as other equity. Now, if you recall in terms of intermediate, division 1, we used to write the word reserve and surplus. But in terms of the division 2, we don't use the word reserve and surplus. We use the word what is called other equity. So is the other equity and is the other reserve and surplus, is that something similar? Well, I would say other equity is a much wider term as compared to the reserve and surplus. But as of now, you can say, yes, it is similar. In terms of your division 1, we used to call this as reserve and surplus. But I'm again putting it that other equity is much wider as compared to the word reserve and surplus. You can say reserve and surplus is going to be a part of this other equity, and there will be something more as well. So other equity, all I can say at this stage, is a wider concept as compared to reserve and surplus. Now, another inputs which I like to give you at this stage. When you look at the equity section in the balance sheet, there is an equity share capital and there is an other equity. In fact, there is an explanation. There is an explanation which a company will give as far as the equity section is concerned. You want to elaborate the movement of the share capital during the year. You want to give a breakup of the other equity which is appearing in the balance sheet. So there is a document which explains all these inputs in detail, and that is called SOKI. So the SOKI, which appears in the balance sheet of the company, which is a new entrant in terms of Ind AS. So as far as SOKI is concerned, it gives you a detailed movement. I would say that if you want to look at the movement of these components, if you want to look at the movements of all these components, the movement of the equity share capital and the movement of the other equity, you need to go to the document which is called SOKI, Statement of Changes in Equity. Okay, let's, I think, consolidate. I've given you 3 major changes. There are more changes to be seen, but as of now, you need to tune yourself coming out of division 1 to division 2. So the 3 big change which we can very apparently see on the balance sheet. I'm just looking at the balance sheet at the moment. So we're going to make a list also with you, because I know people who've studied the division 1, they need to be brought to the division 2. So if I start discussing division 2 without bringing you from that bridge, it's going to be dangerous. So we've seen 3 key changes. We're going to make a list as well where we keep documenting those changes. At the end, we're also going to do a consolidation of those changes. Today's session, I'm again saying, is very, very important indeed. And since this would be, of course, available on the YouTube of ICAI as well, I personally feel that you might feel a need of going back and having a look at the lecture again. Do that. There's no harm. And I feel, yes, you might definitely feel a need. So if you feel that, yes, I need to go back and see this lecture, I think it's perfectly fine. And I think you should look at a second time as well, because if you're learning it for the first time, there might be certain linkages which might be a little disturbing. You will definitely get the flow, but looking the second time will make you crystal clear on the concept. So let me consolidate the picture before I document. I can see 3 key changes on the balance sheet of the company. Number 1, the starting point is assets, unlike equity and liability in division 1. That's one key change. Second, I can see the change in terms of equity. We don't write the word share capital, but we're writing the word equity share capital. In division 1, we used to say share capital, which is equity plus preference. But in terms of division 2, it is equity share capital. The preference share capital is going to be typically a borrowings appearing in the balance sheet. It would be more like considered as a debt rather than an equity concept. Details you'll see in financial instruments. Number 3, the third key change which we can see is that instead of calling reserve and surplus, we call the word OE, that is called other equity. And this other equity is supposed to be the equity share capital, and other equity is elaborated by a document. If you want to see the details, if you want to see the movements in terms of the equity, you need to go and see another document which is called SOKI, Statement of Changes in Equity, which has got 2 parts. The part number A explains the equity share capital movement, and the part number B explains the other equity movement. So just need to remember these 3 things. Let's document this out to you. So you can now start writing with me. I am now going to make some notes as well. You can start writing with me. So I am looking at certain key changes. I'm looking at certain key changes as compared to Division 1 and Division 2. So let me put the heading key changes. So we're looking at the key changes which we can see in the balance sheet. We have not talked of income statement. Our focus is the key changes in terms of the balance sheet of the company. So we're looking at Division 1 and we're looking at Division 2. Needless to tell you, this is based on accounting standard and this is based on Indian accounting standards. So we can see some big changes. Number one, the starting point. So we can say if you look at the starting point, as far as the Division 1 balance sheet is concerned, it starts with equity and liability. But if you look at the Division 2, the starting point in terms of this division is supposed to be assets. And I think if you forget, you can put it in the brackets. I don't mind. You can say, mere paas maa hai. So you'll remember it starts on the asset side, though it's a basic funda. Then next we can go on to the second part and we can say that in this case, when you look at the equity section, the equity section comprises of share capital. And when you consider share capital, it means equity share capital as well as a preference share capital. But when you look at the equity section in the Ind AS balance sheet, in this particular case, they very clearly say the word equity share capital. The preference share capital does not appear out here, and we can definitely make a mention. Preference share capital, generally, I'm being safe. So generally would be borrowings in the balance sheet. So preference share capital, generally you're going to see is going to become borrowings in the balance sheet of the company. And the next difference as we can identify, number 3. So when we look at the equity section in the balance sheet, we can see that we call R and S, that is called reserve and surplus. But when you look at the equity section in terms of Division 2, we use the word other equity. We use the word other equity. Don't get apprehensive of what is other equity, but I think let's make a mention that as far as the concept of other equity is concerned, it's wider as compared to. So it is wider as compared to reserve and surplus, much wider as compared to the concept reserve and surplus. And I think I'd also like to make a little more mention at this stage on this. If you look at this equity, the new entrant for detailed movements, so when you're looking at the detailed movements, there is a document which is called SOKI, and this SOKI is divided in two parts. There is a part A, which gives you the movement of equity share capital, and there is a part B, which gives you the movements of other equity. This is something which you need to keep in mind. So the detailed explanations, the movements are available in SOKI, which has got two parts, equity share capital part A, and there is other equity, there is part B. So if you get any questions in your mind in between, please feel free to ask me. You can put down your questions in the chat box. I'll be happy to answer them there itself. Okay, so far so good. I think I'm not giving you much technicalities. I think you've taken a note of this as well. These notes, of course, will be available on the ICAI LMS as well. So let's now take the journey forward. So that was a basic introduction to the concept. Now, let's go further. I'm trying to maintain a very basic pace. I'm not trying to go fast. I'm not going very slow as well, a very moderate level, so that everybody of you can easily grasp the concept. Because as I said, I'm putting it again, today's session is going to be slightly technical, but it's going to do a lot of grounding work in terms of the other standards to come. Okay. Now I am coming to the balance sheet of the company. Now don't look at the balance sheet right now. In order to explain the balance sheet to you, what I'm going to do, we are going to play a very simple game. And the game which I have created is called 2323. You can silently, sitting at your homes, just murmur out like this that we're playing a game called 2323, feeling. So I am now going to take you to the balance sheet of the company, that we're going to get a little feel of the components of the balance sheet within the asset side. I'm focusing first of all on the asset side of the balance sheet. And to understand the asset side of the balance sheet, I'm going to give you a concept which I have put it as 2323. Let's see. So let's begin with the journey and let's look at the balance sheet of the company. So I will take you to the balance sheet as well. So I'm focusing on the balance sheet, first of all, on the asset side. I'm focusing on the balance sheet on the asset side to begin with. So as I said, when you're focusing on the asset side of the balance sheet, let me give you the structure. If you look at the chapter, which is on Ind AS 1 in the study material, they've explained one of the areas called the structure and the content of the financial statements. So we're working on the structure and the content of the financial statements. So we are going to follow a very simple rule. And the rule of the game is called 2-3-2-3. You'll understand what is this 2-3 and 2-3. I've created this for the ease of convenience. Please don't put it in the exam that the balance sheet asset side is made on the game of called 2-3-2-3. This is only for your ease of understanding. Now, when you look at the asset side of the balance sheet, we're going to first of all divide the balance sheet in two parts. As we are saying it is 2, so I'm going to first divide the asset side of the balance sheet into two parts, then followed by 3, then followed by 2, and then followed by 3. Now, if you divide the asset side of the balance sheet, we can say the assets are segregated in terms of what we call non-current assets. It is segregated in terms of what we call non-current assets. You can start noting this down as well. And it is split in terms of what we call the current assets in the balance sheet. So we divide the assets into two broad categories. One is called non-current and current. So this we used to do at the intermediate level as well. Now let me remind you, though we'll do a discussion of this concept later. When you're looking in terms of what is current and what is non-current, the parameters which decides what is current and non-current is supposed to be what we call the operating cycle. It is the operating cycle of a business which decides what is current and what is non-current in nature. I don't want to deviate from the issue at this stage, and I'm keeping my operating cycle concepts pending. We'll discuss the concept of operating cycle later. So we will be discussing this later. So let me put it out here. We will discuss it later. So we will discuss this agenda on a separate basis, that when you're looking at the operating cycle, what is an operating cycle? Though you all know what is an operating cycle because you've done financial management as well at the intermediate level, and you know the concept of operating cycle. But at this stage, I just want to tell you one thing. The operating cycle, one is called a gross cycle and the other is called a net cycle. In terms of Ind AS 1, we are considering a gross cycle. That means I will be considering inventory holding period. I will be considering a debt collection period, but I will not be reducing any creditors payment period. But don't worry, we'll discuss that later. So how do you decide an operating cycle? There are certain questions in the study material, so that discussion later. And we will also connect you to the concept of what is given in Ind AS 1 regarding the guidance, which is how to decide what is current and non-current. So later. Next. So this is the two broad categories. Then comes the number 3. So now let's have a look in terms of the non-current assets. We are not looking at current assets. Now the focus is in terms of the non-current assets. The non-current assets of the balance sheet will be divided in three parts. The non-current assets is going to be divided in three parts. We have narrowed down the focus. So focus is that the non-current assets is going to be divided in three parts. If you look at a balance sheet, I'm going to soon show you the balance sheet also. There is one asset in the balance sheet which is not an actual asset in the balance sheet. Can I take the liberty of asking you, for those who are connected with me, and can you tell me which assets do you think? Which asset do you think is not an actual asset in the balance sheet? Apply your intermediate knowledge and tell me which asset do you think is not supposed to be an actual asset. We call it as a notional asset in nature. I'm getting some inputs like intangible assets, goodwill, etc., deferred revenue expenditure, and some people said the right answer as well. Well, let me first tell you the concepts like deferred revenue expenditure, miscellaneous expenditure nowhere appears in the balance sheet. Intangible asset is not a notional asset. Intangible asset is something which can't be seen on a physical level, but it's not notional. It is an actual asset, though it cannot be seen. For those who give the answer deferred tax, you're absolutely correct. The deferred tax asset which appears in the balance sheet of the company is what we call, it's a notional asset. So when the structure of the balance sheet was being created, they split the non-current assets in terms of number one, actual, number two, it is notional, and number three, what I called residuary. Residuary means it is the balancing figure which doesn't fall in the actual and the notional category. This is going to be residuary in nature. I think it's now the right time to take you to the balance sheet. As I caution again, don't see anything extra. If you're going to see anything extra and not understand, you are taking your own risk. So let me now take you to the balance sheet and see only what I show you. So have a look at the balance sheet out here, and I'm going to show you a few inputs as well. Let's have a look. So I guess just have a look first of all on the item which I show you. You can see a deferred tax asset. This deferred tax asset is what we can say is a notional asset. Now, what is a deferred tax asset? You have some insights already at the intermediate level. So though you will be discussing this standard in detail when we come to Ind AS 12. So as of now, you just need to know it's a notional asset. And you can see the other non-current assets. Others means the balancing figure. So this is called residuary. This is called residuary in nature. Wow. I'm pretty confident the text is not legible, but I think you all said it is quite legible indeed earlier. Can you just pin my video as well? So let me now take the liberty of asking you, can I say all these items A to H? What do you think they would be? If the DTA is a notional asset, the others is what we are saying is residuary. What do you think the remaining items are? Wonderful indeed. So we can say all these items we can say is actual in nature. Wow. Please don't look at items within actual. If you're going to see things, what I don't show you, it's at your own risk. So we can see the non-current assets is actual assets, followed by notional, and followed by residuary. Life is simple. So when I start reading the balance sheet of the company, I know it is non-current and current too. The non-current is divided in three: actual, notional, as well as residuary. So is this the structure which every company is supposed to apply when they make their financials on Ind AS? Yes. You can pick up the balance sheet of any listed company for that matter, and you're going to see the structure is almost similar. Sir, you said it is going to be similar. You use the word it is almost similar. Well, this is not an exhaustive list of items appearing on the asset side of the balance sheet. Like, for example, there could be certain assets which you would see are not appearing in the balance sheet. I'll tell you, if you just have a look, don't have a look. I'm just telling you on my own. For example, if you look at a balance sheet in a real life, the company may have certain leased assets as well. And those leased assets are called ROU asset, that is called a right of use asset. If you look at the format of the balance sheet, you would not apparently see any ROU assets appearing as a part of the actual asset. So just keep in mind that almost the formats prepared by the companies practically is absolutely similar, but there could be some other items as well. So this is not, you can say, something which is, exhaustive in nature. It is almost, you can say, almost exhaustive, but it is not 100% exhaustive. Okay, don't look anything further. Let's go further. So we can now connect very well that the non-current assets are divided in terms of three elements. And now comes the concept that is called two. I always tell people go on a very systematic stage. So what happens when you start looking at the left-hand side of the balance sheet, they start asking you questions on the right-hand side. So what is the value at which this asset appears in the balance sheet? So let me give you a very simple example to understand the structure. For example, when you go to the restaurant, and when you go to the restaurant, you look at a menu card. And when you look at the menu card, you can see on the left-hand side is the name of the dish. And you can see on the right-hand side is the price list. So as far as the measurement aspect is concerned, I'm going to expose you to the measurement concept separately. I'm going to expose you to the measurement concept separately. So right now you're learning the art of reading the balance sheet on the left-hand side, the menu card, the name of the dish. And then as far as the price list is concerned, it depends upon, is it a snack item, or is it supposed to be a main dish, or is it supposed to be, a dessert? Sir, in the morning, you are taking these names. We feeling hungry. Okay, so let's come back. So 232. So now what we're going to do, we will segregate this actual assets. We will segregate these actual assets in terms of two elements. Just keep the track very clear. Just keep the track very clear that we are segregating the non-current, the actual assets into two components. Now hear me carefully. You might be hearing these terms for the first time, but don't worry, they're easy terms. The actual assets in the balance sheet are classified as non-financial. They are classified as non-financial, and they are classified as financial assets. This was not there in terms of Division 1. When you used to make a balance sheet under Division 1, the concept of segregating the assets in terms of financial and non-financial never used to be there. So in any case, I think many people are asking, sir, how goodwill is an actual asset? Well, goodwill is not something which you can say is notional in nature. It is an asset. It is an asset, though it is intangible in nature. Deferred tax asset is something which you can't recover. So what is that deferred tax? You'll get more insights when you study Ind AS 12, if my time permits, which I guess may not permit me to take you to the insights of deferred tax today. But let's see, we'll give you what exactly is a deferred tax. So no worries on that. Okay, so let me, I think, make a mention that this notional asset is deferred tax asset. Let's put in the brackets DDA. Now, so I said the actual assets in the balance sheet are segregated into two components. So let's do one thing. Before we understand what is financial, before we understand what is non-financial, I want to show you something. You can see the point number H is called financial assets. The point number H, these are all financial assets. So would you like to tell me what is the items A to G? Make your guess what is A to G. If this is financial assets in nature, then what do you think is the remaining items on the balance sheet? Wonderful indeed. So this is non-financial. So, but what is financial? What is non-financial in nature? No worry. let's explain you what is financial and what is non-financial in nature. You might feel this man is getting a little more filmy. In the morning, he said, "Mere paas maa hai," and now he's coming out with another dialogue as well. This is only to make the concept clear so that you're able to understand what is financial and non-financial. You know, whenever I look at the concept of financial and non-financial asset, it reminds me a very popular song in one of the Hindi movies, and it has got some very popular lyrics, which goes like this. It's little Punjabi lyrics. It says, "Sada hak ethe rakh." So the dialogue goes like this. It says, "Sada hak ethe rakh." So in simple words, if you say, rather I would say in accounting terminology, when you say "Sada hak ethe rakh," it means contractual right to receive money. Now hear me carefully. There are two kinds of assets in the balance sheet. One is called financial and one is called non-financial. Certain assets will give you a contractual right to receive. Mind the words. Certain assets will give you a contractual right to receive, and certain assets will give you opportunity to generate money. Every asset gives you benefits. Trust me, every asset in the balance sheet gives you benefits, but certain assets give you a contractual right to receive. Like, for example, if you look at examples of financial assets, you can see three examples on the face of the balance sheet: investments, trade receivable, and loans. For example, I made let's say, a credit sale to the customer. So what does the customer become? He becomes my debtor. So when you make a credit sale to the customer, he becomes your debtor. Now, do you get a contractual right to receive money from your debtor? Yes. For example, I gave a loan to someone. Now, do I get a contractual right to receive this principal money? Yes. For example, I made investments in a company. Will we sign an agreement? Will we sign a contract? Yes. So it'll give me a contractual right to receive. But if you look at other assets like property, plant, equipment, etc., these assets will not give you contractual right to receive. These assets will only give you an opportunity to generate revenue. You can use your machinery to produce goods, and then when you sell the goods, you can earn money. So they will give you opportunity to generate money. So there are two kinds of assets. One is which will give you contractual right to receive, financial in nature. And the other one is non-financial, which will give you opportunity to generate money. So when the balance sheet structure was being decided, we segregated what is non-financial and financial. So let's put in a small little input. So when we say non-financial, we can say they give you an opportunity. They give you an opportunity to generate benefits. They give you an opportunity to generate benefits. They will not give you contractual right to receive, but they will give you opportunity to generate benefits. And when you say financial assets, they will give you a contractual right. They will give you a contractual right to receive. So you will get a contractual right to receive, and that's called financial in nature. Okay, so far so good. So I guess we have very well understood the concept. I guess 2323, the last three is pending. The last three is pending. But we can very clearly see that now if somebody tells you how to read a balance sheet, you're going to tell him, sir, 2323. You're going to split the assets in non-current and current. And then the non-current is in three: actual, notional, residuary. Then the actual is two: non-financial and financial. Contractual right is financial, opportunity is non-financial. So far, so good. Okay, I am getting some question now. So what about we have assets which are used by us to rent them and earn on a contractual basis? Okay, so if you're looking at, for example, a property, which you are going to give on rent and earn money through a rental agreement, they are non-financial. Because when you say the asset is financial, it should per se, it should on the very basic level give you the right to receive. Okay, let me put a simple question to you. If you've got some money in your pocket, please take it out. No, you can't digitally give me that money, nor I'm asking you to pay money to me. But if you got money, just take that money out. Read what it says. If you take out the cash from your pocket, what does it say? It says, I, the governor, am under an obligation to pay the bearer of this person 100 rupees, 200 rupees, whatever. So do you think cash is a financial asset? Tell me. Do you think cash is a financial asset? So can I say it is definitely a financial asset? Because when you're looking at a cash, it gives you a contractual right to receive. So remember, when you're looking in terms of the right to receive, it should be a direct right. It's not that you're going to first, rent the building and get the rent. It should be directly a right to receive. So typically, you're going to learn more on the concept of financial assets when you're going to come to the standard on financial instruments. You'll get more deeper insights in terms of Ind AS 32 and in terms of Ind AS 109. Great. Okay, so we have done 2, we have done 3, we have done 2. The next one is supposed to be 3. So what are we going to divide in terms of 3? The non-financial. Now, the non-financial category is going to be divided in terms of 3 components. So we'll see what are the 3 components. My balance sheet is done. Now let's have a look at the 3 components. Let me go back on the balance sheet out here. So just see what I show you. Please don't see anything extra. If you look at DEF, just look at DEF, nothing more. Just look at DEF. I'm sure you can see something common which is appearing in the item DEF. Goodwill is intangible, other intangible, intangible under development. So we can very clearly say that this entire block is got a common element, and that is intangible in nature. Wow. Similarly, I want you to look at ABC. I want you to look at ABC. So in terms of ABC, there is a property, plant, equipment, there is a CWIP, and there is an investment property. And I think you can rightly, conclude that what is the common element? And the common element is they're all tangible in nature. Wow. So we can say that one is tangible and the other one is supposed to be intangible. So we can see the 2 components of the non-financial: tangible, then there is intangible. And you can see that there is a point number G, which is very specific to the agriculture sector. This is called biological assets. They did not merge the biological assets as a part of the tangible or as a part of the intangible elements. And there was some reason. I'll not come to the reason as of now, but you can say non-financial is tangible, intangible, and biological. So if you come back to the segregation in terms of non-financial assets, I would say the non-financial assets would mean there is tangible assets. The first segregation, it is tangible. The second block is intangible. So we've got 3 items intangible, we've got 3 items in intangible, and there is something which is called biological. Now, what is biological? I'll explain that, not a problem. We'll understand what is biological in nature. So my game of 2-3-2-3 is done. Now you should be able to visualize the non-current assets of the balance sheet. Simply just trying to recall the inputs, you will be able to recall the balance sheet. Let's do a quick consolidation and look at the non-current assets of the balance sheet. Just remember, the presentation goes 2-3-2-3. So let me just consolidate the picture. When you look at the asset side of the balance sheet, so please hear me very carefully now. When you look at the asset side of the balance sheet, we segregate non-current as well as current. How do I decide what is current or non-current? Generally 12 months, but technically depends upon the operating cycle, which we are going to learn later. Then after you've done the two-layer segregation, current and non-current, the non-current is segregated in terms of three: actual, then there is notional, which is called a deferred tax asset, the only notional asset on the balance sheet, and the only notional liability in the balance sheet is a DTA and a DTL respectively. And then there is residuary. What cannot be put under the initial codes is going to be reflected as a part of the residuary, that is called other non-current assets. So we first see actual, and then you see notional, and then you see other non-current assets, residuary. Then comes the second layer of segregation. The actual assets are segregated in terms of non-financial. First, those assets which will give you an opportunity to generate benefits. And then those assets which will give you contractual right to receive the money. And then comes the third layer. The non-financial assets are segregated in terms of tangible, in terms of intangible, and in terms of biological asset. Now, I think the only thing which I need to clarify is what is a biological assets. So, but let me get your thumbs up at this stage. Are we all clear with the game of 2323? Is the non-current assets of the balance sheet clear? So give me a thumbs up if you're clear with the non-current assets of the balance sheet. Okay, that's wonderful indeed. So now let's come back. Now you can see the structure very clear. We've got tangible actual assets, we've got intangible actual assets, and we've got biological assets. They're all non-financial. Then we've got financial assets, notional assets, and it is residuary, that is other. Now, before we go to the current assets, though there is nothing much to be given on the current asset side of the balance sheet, I think let me just give you a basic flavor of biological assets at this stage. Just a very basic understanding, though you will be getting the understanding of biological assets when you do Ind AS 41. So I'm just giving you a very basic inputs on what is biological assets, so that that term doesn't hit your mind. You're at least clear in terms of what is a biological assets. Biological assets is defined in Ind AS 41. There is a standard called agriculture. And the name of the standard is agriculture. The number of the standard is Ind AS 41, which talks about biological assets. They've given a very simple definition of what is a biological asset. And they've defined that biological asset is supposed to be living animal. The definition says it is a living animal, or it says it is a living plant. So the definition, rather than defining anything, tells you that it is either a living animal or it is supposed to be a living plant. So basically plants and animals. Now, if you go a little further, the standard also gives you an insight that animals as well as plants can be further segregated in terms of two. One is called bearer and one is called consumable. So one is called bearer and the other one is called consumable. So whether it's an animal or whether it's a plant, we segregate the animals and the plants in terms of bearer as well as in terms of what we call consumable. Now, let me just give you a very basic insight on what is a bearer or what is a consumable animal or a plant. Now, please hear the words very carefully. If you will sell or consume, if you will sell or consume only the produce of the animal or plant, mind the words carefully. If you are going to sell or you're going to consume only the agriculture produce of the animal or plant, it is supposed to be called as bearer. Don't touch the animal or plant. Don't eat him. You're just only going to consume or sell the produce of that animal, the produce of the plant. So what is the main factor? Let me put it out here. So if you're going to sell or if you're going to consume, if you're going to sell or if you're going to consume only, I'm using the word emphasis, only agriculture produce, only the agriculture produce, then it is going to be called as bearer in nature. Then we're going to call it as a bearer in nature. So I need to put a question to myself. Are you going to consume or sell only the produce of the animal or plant? Then it is bearer in nature. Let me take some example. Let's say I have got a chicken and I am going to sell only the eggs of the chicken. I'm sorry for examples of this sort, which is me given to my vegetarian friends, but I need to give you the larger concept to get the picture. So if you've got, let's say, a chicken and you're going to sell only the eggs of the chicken, it's bearer. If you've got a chicken, you're going to sell the meat of the chicken, consumable. You're going to eat the chicken, it's consumable. And even if you've got a dual objective, you say, I will sell the eggs, I will also sell the meat, it is consumable. To qualify as a bearer, the only parameter is don't touch the animal, don't touch the plant. Only the produce is sold or consumed, then it is bearer. Let me take more example. I've got a teak tree. I'm growing that teak tree so that I can cut the wood and make furniture, consumable. I've got an apple tree. I've got an apple tree. I'll only sell the apples of the tree, not touch the wood, bearer. I've got an apple tree. I'm going to sell the wood also, consumable. So we have understood what is bearer and consumable. You go to eat the animal or plant, it is consumable. You go to only sell, consume the produce, it is bearer. You're going to do a dual objective, it is still consumable. So the moment only the produce is sold or consumed, it becomes bearer in nature. Right time. I want to show you something very interesting. Right time to show you. Please have a look out here. It says biological assets, and the word is other than bearer plants. Other than bearer plants. Not all biological assets are taken out here. It says biological assets other than bearer plant. So are all animals included out here? Yes. All animals are included in this list, whether it is bearer or whether it is consumable. You can see it very clear. Biological asset other than a bearer plant. All animals are included out here, but are all plants included? No, only consumable plants. Only consumable plants are included out here. Then the question arises, where did the bearer plant go? So the question is, where did the bearer plant go in this particular case? Can I say, can you see that word plant in A? Aha. Can you see the plant out here? So this is supposed to be the bearer plant. It goes in point A. So all biological assets other than a bearer plant is G. But as far as a bearer plant is concerned, this plant is supposed to be the bearer plant. So if you've got plants which are bearer in nature, they're going to be A. Rest all the animals and the consumable plants is in point number G. Wow. So this is interesting and getting a little technical as well. I understand that. So we are clear on these terms now. I think I'm not touching DTA at the moment. I'm not interested in touching a deferred tax asset at the moment. Or you want me to touch a DTA? give you a quick briefing on a DTA for the next 10-15 minutes, let's take a word of count. You want me to give you something on a DTA also? Sir, because I think many of you said, sir, it is how it is notional in nature. So you want me to give you a basic flavor of a DTA as well? I see a couple of yes coming in. So let's do that. Let's do that before we go further. So in case of wheat or rice plant, they're both bearer and consumable. Well, we'll not get into a detailed discussions at this stage. So you are going to look at the other things. And I'm getting some very technical questions also from somebody. So what is an OCPS as well? Oh my God. Well, let me tell you, friends, we're just learning the basics, ABCD. What is OCPS and all those things you're going to learn in financial instruments. Let's not complicate things for people at this stage. Sometimes the questions can be very scary for others as well. So let's not get into all those things. You see, every item in the balance sheet, let's give you the insight. Every item in the balance sheet of the company is governed by some index or the other. So as you look at items like property, plant, equipment, investment property, there is a standard on every item. So my piece of advice also is when you are going to study any standard, please go back to the schedule 3 and try to link, what you're studying on that item. You should be able to locate, able to link your schedule 3 knowledge as well as the Ind AS knowledge so that at the end you should be comfortable in terms of making financial statements. So no technical questions we'll get into. So even though he said, rice, wheat and all, you're going to get all those detailed insight on Ind AS 41. Right now we're just looking at a macro level of things. The micro level of things will come when you go to the specific standards in terms of things, right? Okay, so I think you said requested for a DTA. Let's go to DTA. Now, at this stage, let me caution you. What I'm about to tell you is not technically correct, but it is still correct. Sir, what I'm about to tell you is not technically correct, but still correct. Because you will see later the way deferred tax is computed. I am just giving you a concept why a DTA is notional. We're just going to spend around 10-15 minutes on that and come back to the agenda. Because many items in the balance sheet which needed some insights I've given you. I've told you what is a biological assets. We'll give you 1 or 2 more items as well, and we'll keep pushing forward. So we are now trying to understand the concept of a deferred tax. Now, please hear this very, very carefully. Because I know many people don't even understand deferred tax. So I think this is to give you why it is a notional asset. So please hear this very carefully. Next 10-15 minutes, very crucial for understanding. I'm going to take a very simple example in order to explain the concept of a deferred tax. So I'm going to make 2 statements to you. One statement I'm making from the income tax point of view, and another statement I'm going to make from the accounting point of view. So see me very carefully, hear me very carefully, because this is going to build your concept in terms of deferred tax. So let's consider a period of 3 years. And let's consider PBDT, that's called a profit before depreciation and tax. So that's PBDT, profit before depreciation and tax. Let's take a common figure of 200 lakhs every year. So let's take a common figure of 200 lakhs every year. All the figures are in lakhs. Now, we need to understand one thing before we take further. The way income and expenses are dealt in accounting and the way the income and expense are accounted are basically dealt in income tax are sometimes different. Because the Income Tax Act tells you that this expense is allowable or not allowable or partially allowable. But from the accounting point of view, it's more like, you incurred an expense, you need to account. So there is a different way we look at income and expenses in taxation and in terms of accounting. And this is one of the main reasons why a deferred tax arises. So I'm going to take an example. in order to explain the picture to you. So let's say, for example, my company purchased a machine on a scientific research. You know, as per Section 35 of the Income Tax Act, that when you purchase a machine on a scientific research, you get a depreciation, you get a full depreciation in the year of purchase. But from the accounting point of view, I would say if the machine has got an N number of life, you can't take a depreciation in one go. But the income tax people are incentivizing the company that you doing some research for the country, so let's give you a benefit and let's give you full deduction. So let's take the example that my company purchased, let's say, an asset for 150 lakhs, and the income tax people gave me a full depreciation in the year of purchase itself. So if I reduce this depreciation, I can call this as PBT, and this can be technically called as a taxable income. So this PBT can be technically called as a taxable income. So this is 50 and this is 200 and this is 200. Simple and straight. I've taken a depreciation based on the provisions of the Income Tax Act. Now, if I would calculate my tax, let's say at the rate of 40%, let's assume a 40% tax rate, it works out at 20, it works out at 80, it works out at 80. So I will be able to calculate my profits after tax. So we can take the PAT, and that's 30, and that's 120, and that's 120. Simple and straight. I don't see that there would be any challenge in terms of understanding that how do I get my profit after tax considering a depreciation based on the tax provision. Now, for a moment, what I want to do, I want to consider things only from the accounting perspective. I don't want to look at the way things are under the taxation regime. I want to look at things exactly as a pure accountant. So let me consider my PBDT, and let's consider that there is no difference in the PBDT from the accounting and from the taxation perspective. Let's keep it 200. Now, when you consider a depreciation in this case, my accounting funda tells me that the asset has got a life of 3 years. My accounting funda tells me that the asset has got a life of 3 years. So I say, okay, if it has got a life of 3 years, then I am going to spread on a straight line basis a depreciation which is 50 each. So instead of taking 150, we spread the depreciations over a period of 3 years because it has got a life of 3 years. So we get a PBT, but this is supposed to be accounting income. It is not a taxable income because this is from the accounting point of view. So we get a PBT which is 150. Now let's consider the taxes at the rate of 40%. So let's compute a tax at the rate of 40%, and this works out at 60 for all these years. And with this, we can also calculate the profit after tax as well. So if I look at the PAT from the accounting point of view, it works out at 90. Simple and straight. I'm sure you would have understood the two charts. One is from the taxation point of view and one is from the accounting point of view. Now, hear this carefully. Earlier, I'm looking at the earlier approach. When the deferred tax concept never used to exist. I'm saying I'm looking at the earlier approach when the deferred tax never used to exist. So what the company used to do from the accounting point of view. If you take 3 years, you get a PBT. I used to report to my shareholders. My PBT is 150. So I used to report my PBT from the accounting point of view is 150, and I used to reduce a tax as per Income Tax Act. I used to reduce the tax as per the Income Tax Act. So we used to say it's 20, 80, 80. So we used to say we paid a tax of 20, 80 as well as 80. And we used to calculate that this is my profit after tax, that is a book profit. This is 130, this is 70, and this is 70. The figure of taxation was taken from the tax point of view. The figure of taxation used to be taken from a tax point of view. Now, please hear me carefully. The next 5 minutes, you get the concept. Now, if you look at this particular statement, anybody reasonably looking at the movement from year 1 to year 2 would say the company has gone bad. You will look at the profits for the first year, you'll say 130, good. Second year, look at the profits, it is 70. You say the company's performance has gone down. But technically, the company's performance has not gone down because you paid lesser taxes in this year and then you paid more taxes in the years to come. The income tax provision reduced your taxes in year 1 and you landed up paying more taxes in the years to come. So suddenly what came to the mind of the accounting standard setters was that why are we booking an expense? Tax is undoubtedly an expense. So what came to the mind is, why are we booking an expense based on taxation principle? If tax is supposed to be an expense, we should book it according to accounting funda. So they decided we are going to book an expense of 60 every year. And let me say this. If you see something, let's add the taxes of 3 years. That works out at 180. Let's add the taxes of these 3 years. That again comes to 180. By chance or got to be, undoubtedly got to be. If you look at the taxes in these 3 years, it is coming to 180. And if you look at the taxes in these 3 years, it is 180. Sorry for what I'm saying. But do you think the government has actually incentivized me? Do you think they've actually given me some kind of benefit? I would say technically not. Ignore the concept of time value of money, but are they actually doing any benefits to me? They're not doing any benefits to me. I pay a lower tax this year, but followed by more taxes in the years to come. And if I book my tax according to what they ask me to pay, mind the words, if I book a tax according to what they ask me to pay, my income statement goes for a toss. My shareholder is unable to appreciate that the profitability of the company has not actually gone down. And if I give him a statement like this and he compares the profitability, he sees a stable growth. So booking an expense that is taxed as per taxation was getting dangerous for the companies because it was difficult to explain the performance of the company if you're going to book tax on the payment basis. So we said, let's consider that we're going to book taxes based on if your accounting income, mind the words, if your accounting income is considered as a taxable income, this is what the tax we're going to pay. So what we decided, let's have a look out here. So in year number one, so we said we'll put an entry, expense gets a debit and a liability gets a credit. The expense will be recorded based on accounting funda. And the liability will be created according to what I owe, the taxation funda. So when you're going to record the expense, you are going to follow accounts. When you're going to book a liability, you're going to follow tax. So we decided that expense will be recorded according to the fact if my accounting funda works. If my accounting income becomes a taxable income, I will book that tax. But liability is what I will book, what I actually owe to the government, the income tax department. So let's go back and see what is the accounting funda tells me that what is the expense. It is 60 lakhs. I'll book 60 lakhs. What does my taxation funda tell me that what is my liability to the government? It is supposed to be 20. So I book this as 20. Now there is going to be a mismatch, because you are going to record an expense based on accounts and you're going to record a liability based on tax. So how do I match the books of accounts? Because it's a double entry bookkeeping. So what we do in order to match the figures, we created this 40 and we call this as a deferred tax liability. Can the government sue me in the court of law and tell me, boss, you owe this money to me? Of course not. This is not a liability where the government can sue me in the court of law and say that give me this money. So is it an actual liability or is it a notional liability? It is a notional liability. It is getting created because based on accounts, you're booking an expense on accounting fundas. And you're booking your liability based on the taxation funda. And therefore, in order to complete a double entry bookkeeping, we're just creating a notional balancing figure, that is a DTL. Now see the position in terms of year number 2. If I carry forward my understanding in terms of year number 2, let's see how much expense and liability will I book. Again, when I'm going to book an expense, I am going to follow the accounting funda. And when I'm going to book my liability, I am again going to follow my income tax funda. So let's see. From the accounting point of view, what is the expense? So we can say if my accounting funda is accepted, my expense is supposed to be 60. So we book an expense according to accounts, there is 60. And what is my liability as per the income tax? What I owe them is supposed to be 80. So in this particular case, I book it 80. There is again a double entry bookkeeping gap. So we need to actually adjust the difference. So what do we do in this particular case? We are going to debit a balancing figure 20, which is the DTL created earlier. So you created in one year and it got reversed in the next year. You created in a particular year and it got reversed in the next year. So in this particular case, you'll see even the entry in third year will be same. So you create a deferred tax liability notionally in year 1 and it gets reversed in year 2 and 3. So therefore, did you get the basics that deferred tax liability or even a deferred tax asset is not actual asset or actual liability. It is completely notional in nature. And by doing so, what we were indirectly trying to do, we were trying to show that the profits after tax is 90-90. Because when we were recording the expense based on what we owe to the government, it was disturbing the profitability presentation. And therefore, we decided that since at the end of the day, the total taxes paid and what I'm going to charge over a period of 3 years will be equal, why record what you pay? Why record on the basis of cash basis? Why don't you record on accrual basis? So accrue the expense as per accounts. Mind the words. Accrue the expense as per accounts and pay the liability as per tax. So your balance sheet is taking what you pay, what you owe, and your income statement is taking a hit what you are supposed to pay, and the difference is settled in terms of DTA, DTL, which is notional in nature. Did you get the funda? Did you get the fundas clear? This was just to give you an overview of the deferred tax assets and deferred tax liability. Great. So this is getting very interesting and technical at the same time. I told you in the morning as we started, this class is going to be very important. There is more to go. There is more to tell you because this is going to create a lot of foundations in terms of understanding the standards on Ind AS. Because as I come to income statement, I'm going to give you some more crucial inputs as well. Okay, so why this process? We can see PBT for performance. Not everybody can appreciate and understand financials. Though we always presume that people reading financials have got the knowledge and the caliber in terms of things. But who would understand? Anybody who looks at your statement apparently would say, oh my God, the profit is actually gone down. And then why there is a need to report 70? I can always smoothen the profits. If my performance is stable, let me, record something which is stable. Okay, so this is done. I guess now let's have a look at the asset side, non-current assets for any one or two inputs out here. So as far as the inner details are concerned, don't get worried of that. So deferred tax account in a way plays a dual role of asset liability creation, and at the time of setup, it plays a role of income and expense. Yes. So you're going to see more details in terms of Ind AS 12. Right now, I'm just giving you a basic structure of the deal. Okay, so this is the basic structure. Now let's come to the current assets with you. We are now going to look at current assets. There is nothing much to be explained on the current assets. The major part on the non-current assets, I think tonight you're going to see me in your dreams. Say yes. And I'm going to tell you in your dreams that the balance sheet is made on the game called 2323. So you'll remember easily the concept of 2323, how the balance sheet structure and the content gets done. Okay, now let's come to the current assets with you. If you look at the current assets, they start with inventory, because inventory is supposed to be one of the major elements on the current asset side. A company has got a major amount in the balance sheet in the form of current assets, so it starts with inventory. You can see it is financial assets, so inventory is non-financial. And then it is followed by financial assets, where the same examples are given. Except you can see cash and cash equivalents is, of course, not in the list above, but it's a part of the list out here. Okay, let's now see further. Then there is a current tax assets, and then there is other. Others, of course, would mean residuary. Others, of course, would mean residuary. And when you say current tax assets, I would say it's more like advanced tax. You know, if somebody were to tell me how the current assets are organized, I'm now coming to the current assets. So I would say the current assets has got four components. I would say it is non-financial, then followed by financial, and then it is followed by tax related, and then it is residuary. That makes my entire balance sheet on the asset side. So let me do one thing. Let me just come back and just complete our chart which we started with. So I think let's complete that current assets part as well before we go further. So in the current assets, we can say that we've got a total of 4 items how the assets is presented. So this chart will give you the entire feel in terms of the asset side of the balance sheet. My asset side of the balance sheet is done. Okay, let's now take it further. Okay, now the current assets would mean that there is a non-financial assets. In the brackets, I'll put it as inventory. And then we have got in the second point, we can say financial assets. Then third one, I would say it is tax related asset, advanced tax. And then I would say it is others. We can call it as residuary. So only 4 components are there on the current asset side. That is how the structure of the asset side of the balance sheet is being created. So now if you sit down and just even close your eyes for a minute, you would see the entire structure of the asset side of the balance sheet running at the back of you. So if somebody were to tell me, how does a balance sheet look like? Trust me, it looks very well structured. You've got, first of all, non-current, in which you've got actual, notional, residuary. The actual is non-financial, financial, and the non-financial tangible, intangible, biological. That's non-current, 2323. And if you look at the current assets, I would say it again starts from non-financial, financial. You can see the structure is almost the same. It is supposed to be non-financial and financial. Then there is tax related, and it is residuary in nature. So you've got non-financial, financial, tax related, and residuary. Asset side is done. Now we need to take you on the equity section and the liability section in the balance sheet. Let's begin the journey. So we are now going to go to the balance sheet on the liability front. So let's go to the liability side. See only what I show you, friends. Don't see anything extra. So don't see anything extra, see only what I show you, nothing extra to be seen. Now, you can see on the liabilities side, we have got equity and we have got liabilities. We'll see the liabilities later. Let's focus only on the equity. So we said equity has got two components, equity share capital and other equity, and the movements are given in SOKI. Now, friends, we are going to speak a little more technical. Sir, since morning, you've already given us a very high level of dosage. We can see the transition from the class number 1 to the class number 2, from the introduction and to the Ind AS 1. एक मुझे ना शेर याद आ रहा है, आप कहें तो पहले एक शेर सुना दूं? हाँ सर, सुना दो. When there is a share, you should say Irshad, then I'll give you the share as well. As I see the journey which is being taken today, ek share sunado, sir. I like it. Somebody at least said Irshad. इब्तिदाई इश्क है, रोता है क्या, आगे आगे देखिए होता है क्या. Don't ask me the meaning. You can Google and get the search. Okay, so now let's focus on the other part of things. So let's take you further on the other part of the things. You could see the artificial intelligence when you speak something, suddenly in terms of Hindi, it tells you, please confirm the language in which you're speaking. Is it English or is it Hindi? Of course it was Hindi, but I'm back on the track in terms of English. Let's now go further. So I am now about to show you this document which is called SOKI. So please see this very carefully. This is what is the statement of changes in equity. This is what is called statement change in equity. Please see only what I show you. Don't see anything else on this case. And Karthik says the class seems to be more easy than the share. Oh my God, was that so technical indeed? Okay, so let's come back. You can see the statement of changes in equity. That's what we call SOKI. Now, there is a part number A, which is equity share capital. And you can see that it tells you the balance at the beginning of the year. It tells you the balance at the end of the year. And we are able to indicate whatever is the movements which are taking place from the beginning till the end of the year. So the component number A is supposed to be the breakup, the movement of the equity share capital. You're telling the stakeholders, this is the balance at the beginning, this is the balance at the end, and these are the movements. Don't look in between. Don't look it in between. It's just the movements. Now, there is a second component. Now, see this and don't get scared, because this is the document which you're seeing for the first time. So I'll just give you some very basic insights. We'll get some basic insights on that. So don't get worried as you look at the size of the format. Do let me know, friends, if it is visible to you. Is the visibility good? Can I take it further? Okay, that's great. So let me just continue with this. Now, please hear me very carefully. Certain logics will get developed very soon, but just first hear me very carefully. So we can see the part number B of SOKI, that is called other equity. I'm sure you look at the reserve and surplus. Or let's do one thing. If this is not very visible, let me zoom it down further as well, because some people might have a little problem. So let me do one thing. Since I am more interested in showing you the headings, I'll just scroll it down so you can see it very carefully indeed. I think this should be good to watch. I think, yes, this should be good to go. So I think this should be visibly very clear. Okay. Now, this is the part number B of SOKI, that is called other equity. Now, when in a practical life, we make this SOKI, we create a total of 3 tabs. So I'm just going to give you a flavor. How do we do it in a practical world as well? Because at the end of the day, you're going to apply this subject in a practical world as well. So you can see, don't look at the first column at this stage. Just look at this one. Just look at this one. There is something called equity component of compound financial instruments. Don't get worried on that. So there is one element which is there. This is what we call a tab 1. This is what we call a tab 1. You're going to study about this tab in detail when you come to financial instruments. So don't get worried on the term as of now. Then you can see the reserve and surplus. This is the reserve and surplus. And this entire reserve and surplus is called the tab number 2. In fact, if you go back to division 1, I said the reserve and surplus is being replaced. The reserve and surplus is being replaced by other equity. So you can see reserve and surplus is just one element of this other equity. There is more in terms of tab 1 and there is more out here. So you can see that in terms of the tab number 2, there are items with which you're very familiar. For example, a capital reserve. For example, a security premium. For example, other reserves and retained earnings. So you're very well aware in terms of the tab number 2. Now let me caution something. As you are going to study the Ind AS, you will see that you will get a knowledge of what goes in tab 1, what goes in tab 2. And this entire portion, leave the last one. This entire portion, this is what we call a tab number 3. This is what we call a tab number 3. Now, what goes in 1, 2, 3 is not to be bothered at this stage. You just need to know one thing in life, that when you look at the other equity, there is a tab number 1, there is a tab number 2, which is called reserve and surplus, and there is a tab number 3. And let me tell you the name of this tab 3. It is called other comprehensive income. Aha. So at least at this stage, what should go at the back of the mind is this chain. Don't worry, I'll pen down the notes also to you. What should be clear in your mind? When you look at the equity section in the balance sheet, we're focusing on equity, then we come to liabilities after that. When you're looking at the equity section in the balance sheet, there is an equity share capital explained by SOKI Part A. There is a other equity in the equity section explained by SOKI, that is Part B. And this other equity has got 3 tabs. The tab number 1, which you're going to study later. The tab number 2 is called reserve and surplus, which is similar to the division number 1. And there is a new entrant, and that is tab number 3, which is called other comprehensive income. So you just need to know that SOKI, other equity, has got 3 tabs. Tab 1, then there is a tab 2, which is reserve and surplus, and a tab 3, which is called other comprehensive income. I know what I'm saying is slightly technical, but you need to get this framework clear. You'll get more insights of this OCI as I come to the income statement, which is P&L plus OCI. Let's, I think, document this out now. Let's document this bit as well. So I guess let me just add in. So let's make some notes. You can start copying this now. I am now focusing on the equity side. You can see we are going absolutely systematic. I picked up the balance sheet. I talked of the assets, current and non-current, done. Now we're talking of equity. Then we go to talk on liabilities. The balance sheet will close. Then we go to the income statement. That's how my flow of discussions will come. Then we need to discuss the operating cycle as well. Not everything today, of course, we're going to discuss that in the next session as well. So we're focusing now on the equity side in the balance sheet. So this is the equity component in the balance sheet of the company. So let's divide this equity into 2 elements. So we're looking in terms of equity in terms of 2 components. So we can say one is the equity share capital. So one is the equity share capital. And the other element is supposed to be other equity. So the other element is what is called other equity. So let's, I think, put it across out here that when you're looking at the equity share capital, the detailed movement, so when you're looking at the equity share capital, the detailed movement is seen in part A of statement of changes in equity. You want to look at the detailed movements, you look at the part A of the SOKI. Similarly, when you look at the other equity, if you want to have a detailed movement, you want to look at the detailed movements, you need to go to the part number B. So this will be part B of SOKI. So this is going to be the part number B of statement of changes in equity. And I think another thing which you need to know is that this part number B is divided in 3 tabs. So this part number B is supposed to be divided in terms of 3 tabs. There is a tab number 1. I'm just going to give a nomenclature at this stage without getting into any details. So we'll just make a mention that this is something called equity component. You just need to remember the name as of now. Details will come later. So equity component of CFI, that's called compound financial instruments. So you're going to study this tab number 1 when you come to Ind AS 32. So as of now, don't apply your mind. You will study this in detail when you come to the Ind AS 32, that what is this equity component of CFI. Then there is a tab number 2, which you are quite familiar with. The tab number 2 is the reserve and surplus. So it is supposed to be the tab number 2, which is called the reserve and surplus. And this is, you can say, similar to division 1. This is similar as far as division 1 is concerned, absolutely similar to the concept of division 1. And something new which is also entered in is tab number 3. And the tab number 3 is called OCI. That's called other comprehensive income. That is called other comprehensive income. So you just need to know the names as of now. So tab 3 also we will discuss in detail later. So maybe today slightly. So we will discuss later. We will be discussing the concept of OCI in Ind AS 1 itself, but we'll discuss it slightly later. So this is as far as the equity section in the balance sheet is concerned, where you've got 2 elements, equity share capital and you've got other equity. You need to be clear that the equity share capital movement is in part A of SOKI and the other equity is in part B of SOKI. And this other equity has got 3 tabs, tab number 1, tab number 2, as well as tab 3. So tab number 1, something called equity component of CFI. Don't get worried. Part number 2, tab number 2 is something what you already know, that is reserve and surplus, and tab 3 is a new entry. So tab 1 and tab 3 are the new entrants. Rest everything is the same. I hope everything is clear so far. So far, so good. Everybody's clear with this. So I am done with the concept of asset side of the balance sheet, equity section of the balance sheet. I think now it's time to give you some break as well. Yes, sir. So I'm sure you need some break also at this stage before we discuss the liability side of the balance sheet. So we are going to look at the liability side. My assets is done. So we just left with the liability side. Then we'll go to the income statement as well. So liability side is not very challenging enough, because even if you look at the liability side of the balance sheet, the liability side of the balance sheet again is comprising of almost like 4 items on the non-current and 4 items on the current. So that would not take much of a time, but I think let's keep that as a warm-up exercise after the break. Okay, so it's almost, I think, around 8:40, something around 8:40. So we'll see you in 10 to 12 minutes time. Relax your mind, something more interesting coming after the break for you. So just relax your mind. I'll see you after the break. So I hope you had a relax of mind, fresh to do some more inputs today. Okay, I'm getting some messages. Thank you very much indeed, Karthik. That's great. And thank you, Jeannie, as well, I think, for the handwriting. Okay, that's wonderful indeed. Okay, let's take the journey forward. So far we have done the discussion on the balance sheet, and we have focused in terms of the asset side as the liability, only the equity section. Now we're going to go on the liability side of the balance sheet. Nothing major in terms of the liability side. We're not going to get into details on the liability side right now. We're just going to have a basic structure, move on to the income statement. Now, you will see something very interesting, which I want to ask you. You can see liabilities are segregated in terms of non-current and current. So the first layer of segregation is same, just like the assets. So we segregate the liabilities in terms of non-current and current, and what will decide what is current or non-current is again the operating cycle, which I will give you a flavor very shortly. Did you notice something that on the non-current liability, they're starting with financial liability, and also in terms of current liability, they're starting with financial liability? I would now like to give you the focus. When we were discussing the assets, whether it was non-current or it was current, they were first saying non-financial, and then it was followed by financial. But in terms of liability, you can see first we are segregating the financial liabilities. So what is a financial liability? Just like a financial asset is a contractual right to receive, a financial liability is a contractual obligation to pay. So there are two kinds of liability. One is where you've got obligation to pay. But remember, the obligation is by way of contract, not by way of law. For example, if I am supposed to pay income tax to the government of India, it's not a financial liability because it is not a contractual obligation. It's a statutory liability. It's a legal obligation. So when I say financial liabilities, those liability where you are under a contractual obligation to pay is financial, and the other liabilities where there is no contract, but you may be statutorily obliged or otherwise, they become what is called non-financial in nature. So they segregated the financial liabilities, then they've created provisions, then there is a notional liability, and then there is others. So you can see something interesting. The segregation is financial liability 1. The segregation in terms of provisions, I would say, is non-financial liabilities 2. Then I would say DTL becomes a notional liability, that is 3. And you can say others, that becomes residuary in nature. So if somebody were to ask me that how the non-current liability of the balance sheet is organized, so I would say there are 4 elements on the non-current liability. Financial, non-financials, that is provisions. Then there is notional. Just like a notional asset, we've got only one notional liability, that is a DTL, and there is residuary, which is what doesn't fall in the above codes is going to fall in other non-current liability. Simple and straight. We're not getting into deep more than that. Just a basic structure. 4 components in terms of non-current: financial, non-financial, notional, others. Great. Or you can even call it like this. You can say financial and non-financial is something we can say actual. Though even others is also actual only, but I'm just calling it as residuary nature. So you can put it as 3 as well: actual, notional, residuary, and then actual, financial, non-financial. Simple. Let's do one thing. Let's create some notes on the liability as well. So you can start writing. Let me just add on the notes to you on the liability side. Don't worry, we'll do a little consolidation of the learnings today towards the end of the class. So we're looking in terms of the balance sheet, that is liability side of the balance sheet. So we can say liabilities will be segregated in terms of 2 elements. One is, we can say, non-current liabilities, and the other one is the current liabilities. So on a very apparent level, what will decide what is current or non-current is generally what is payable in 12 months is current. Generally, what is payable beyond 12 months is current. But technically speaking, all depends upon the operating cycle. So let me put it like this. What is current and what is non-current is going to depend upon the operating cycle of the business. So the operating cycle of the business will decide what is current or what is non-current. We will very shortly discuss the operating cycle very shortly. And then when it comes to non-current liabilities, it is segregated in terms of, let's put it as first three categories. It is segregated in terms of actual, and then it is notional, and then it is what you can say residuary. Residuary is again actual assets, but it is others. So the only notional liability is DTL. That's the only deferred tax liability, only notional liability which appears in the balance sheet. And as far as actual is concerned, you can further segregate the actual in terms of two elements. First, we will segregate financial liabilities, and then we segregate what is non-financial. Simple and straight, nothing much technical. So I think just let's also make a little mention as well. When you look at the financial liabilities, they're supposed to be liabilities where there is a contractual obligation to pay. So liabilities where there is a contractual obligation to pay, that becomes financial liability. And non-financial would be other than contract. So they are not by virtue of contract, but they are other than contract. One of the examples could be by law. There might be a legal obligation. I might be obliged on a contractual, on a legal levels to pay this. That's non-financial. And the only liability which is being presented out here is provisions. So my non-current liabilities is taken care. We are now clear with the segregations, the layer. And let me pinpoint something out here as well, so that once you revise, you keep that in mind at a later stage. So let me just put a small note out here. In case of assets, we first show non-financial, and then financial. So first we show non-financial and then it is followed by financial. But unlike in terms of liabilities, you can clearly see we are showing first financial and then it is non-financial in nature. Let me know if you're done. We will take it forward. Just give me a message. Once you're done, I'll take this further. Right, done. Wonderful indeed. So this was on the non-current liability. Now I will take you further. Let's go to the current liabilities as well. The last phase of the balance sheet. So let's go to the current liabilities. And there is nothing much on the current liability as well. Just like 4 items are there on the non-current as well as on the current. We just got simple 4 items on current as well. So one you've already seen, that is financial liability. I think let's have a look at the other item now on the current liabilities. I don't know for what reasons they've taken other, that is residuary first. I could not really understand the logic of why they took residuary in between, because they've shown the provisions, which is non-current liabilities, non-financial afterwards. And then there is current tax liability, which is supposed to be tax-related liability. So why was the other shown earlier? Maybe what came to the mind was that they wanted to show that actual assets, even residuary, is actual. But I don't know. If you technically ask me, why did they show financial followed by residuary and then it was non-financial and tax related? Difficult to explain. So I think I'll not get into that technical discussions. We'll just put it directly out here. So let's directly put this in terms of current liabilities. We've got 4 components. So current liabilities, we'll just quickly put the 4 components and close the balance sheet of the company. The first one is supposed to be financial liability. So the same concept, contractual obligations to pay. Then it is residuary. Then it is residuary, which is others. And then it is non-financial liabilities, which is again the concept of provisions. So provisions are taken in non-financial, and then it is followed by tax related. Then it is tax related. So we can say it is current tax. This is what they call as a current tax. Basically, you can say your tax, actual tax liability, which is payable. So far, so good. The balance sheet is closed. You want me, friends, to do a technical discussion now or simple discussion? I think you're going to say, Sir Simple, let's keep the technical discussions maybe a little more for the next session. Or maybe we can give you a partial discussions at this stage. I'm getting inputs are technical. So give me a word of count. How many of you want me to do a little more technical discussions at this stage? I don't know if since morning I've been speaking to technical indeed. What is left as residuary? What doesn't come in 1, 3, 4 comes in point number 2. Okay, we're getting a little mixed response. So let's do one thing. Let's do a little mix of simple and technical, because I want to give you a little exposure on the operating cycle as of today. We'll discuss more of that later, but let's, I think, now come to the operating cycle. So balance sheet is closed, and SOKI also, basic funda, is closed. Now, before we look at the income statement, or let's do one thing. I think let's discuss a bit on the income statement, just a basic overview. We're not going to go very technical today. We're just going to do a basic overview. Yes, sir. Okay, let's begin. So let me zoom this. Let me know if this is clearly visible. Just let me know, is this visible to you? Good to go. I guess visibility is fine. Great. That's wonderful indeed. Hazy. Okay, that could be due to your internet. And let me zoom this also further. This should also be good to see, I guess. Yes, I think this is good to see. The size seems to be good. Okay. Now, please see this carefully. Don't worry on the notes. Don't worry on the notes. I am going to give you some inputs on the income statement. We're going to make the notes later. So don't worry on the notes. Just hear me carefully. And as I said, you might feel the need of watching this class again. And this is only to strengthen your concepts. And even the next class is going to be something which is very interesting. You would like to see it again in terms of getting your concepts absolutely strong. Do it, not a problem. Okay. Now, before I start with this particular statement, what comes to my mind is a very simple question. Let's put a question to you. I guess I've not been asking many questions, though I'm very fond of asking a lot of questions as well. And many of you are connected out here. So let me ask a very simple question and let's get your answers in the chat box. When I look at the income statement, it always, one question comes to my mind. One is revenue and one is income. Can you tell me what is wider in nature? Is revenue wider than income or income wider than revenue? Give your answers on that. What do you think is bigger? Is income wider compared to revenue or revenue wider as compared to income? And I'm getting a mixed response. Some people are saying that income is wider. Some people are saying that revenue is supposed to be wider. I think I'll better give you an answer like this. Basanti, tumhara naam kya hai? Now you cannot say that Basanti has got a name Basanta. So let's, I think, begin the journey. See and analyze and give me the answer. If you see the income statement, you can see revenue. You can see other income and then it's total income. Please look at the equation and you can decide. It says revenue from operations and it is other income and the word is total income. I don't think so. I need to tell you that what is wider, it very clearly says that income is wider as compared to revenue. So let's, I think, first of all, understand this bit, that is what is revenue and what is other income. But before that, I want to show you something which is very important and is different as compared to your Schedule 3. If you remember, I started my journey, and when I started my journey, the first thing which I did out here was I had given you this distinction chart. I had given you this key changes in terms of balance sheet. On a similar level, I want to give you some key changes in the income statement as well. So see only what I show you, nothing extra. So just like we looked at the key changes in the balance sheet, I want to look at key changes in the income statement, because you are transiting from division 1 to division 2. So you need to have a look at the key changes. So just see what I show you, nothing extra, nothing less. So let me just go back to the income statement and show you something. Just have a watch out here. Just see only what I show you. Don't see anything extra. Can you see other comprehensive income? Don't get worried on what is this other comprehensive income, but you can see that there is an other comprehensive income. There was nothing called other comprehensive income, OCI, in division 1. So this is a new entry, that is other comprehensive income. Immediately questions will shoot to your mind, sir, what is taken in other comprehensive income? I will not discuss that today. We're going to discuss that agenda in detail in the next class. But just one thing which you need to keep in mind, the key change is that there is OCI, which was not in division 1, it is in division 2. What enters OCI later? Next, let's come back. I now want you to look at the item number 5. It says profit or loss before exceptional items and tax. If you see, it says profit or loss before exceptional item, as well as it says tax. I guess if you rightly remember the division number 1, you would recall that it used to be called as profit or loss before extraordinary item, exceptional item, and tax. Oh, yes. You studied Accounting Standard 5, where there was something called extraordinary item. In terms of Ind AS, there is nothing called extraordinary item. The concept of extraordinary item has been deleted from the dictionary of Indian Accounting Standard. There is an exceptional item, but what you studied as extraordinary item, that is gone. Second key change. Then let's give you a third key change as well. As I said, the changes are 3 in number, the major one. Now let's look at further. I want you to look at point number 10. It says profit or loss from discontinued. It says discontinued. If you remember the division 1, it used to say discontinuing. It used to say discontinuing, and now it says it is discontinued. I'll not come to the distinction between what is discontinuing and what is discontinued, but you need to see that the changes have come in, and we use the word discontinued in terms of this division. So I would say there are 3 key changes. I'll document them as well. So let's get the focus on the 3 key changes in the income statement. Earlier in division 1, there was nothing called OCI. And in terms of division 2, there is OCI. But what enters the other comprehensive income? That's what we're going to learn slowly later. Second, there was a concept called extraordinary item in division 1. But if you look at the division 2, there is nothing called extraordinary item. The concept of extraordinary item deleted from the Indian accounting standards. And number three, in terms of division one, we used to have discontinuing operations as per AS 24. And now we've got something which is called discontinued operations. And you're going to study more in detail in Ind AS 105. Let's, I think, make some key inputs to you. So let's, I think, make some key changes. You can start copying. You can start copying this. We're now looking at the key changes in terms of division 1 as well as division 2. So we're looking at the key changes division 1, accounting standard, and we're looking at the changes in division 2, that is Indian accounting standard. You can note this down. So here we're looking at the key changes. We're looking at the key changes in terms of income statement. Just like we looked at the balance sheet, we're looking in terms of the income statement as well. So for easy remembrance, I've kept the numbers three. Three key changes in the balance sheet, three key changes in the income statement, balance sheet 2323, current assets, current assets, non-current liability, current liability 444. Easy, isn't that so? Okay, so the first thing is that there was no concept of OCI. There was no concept of other comprehensive income. OCI has been added as a section, underlined section in income statement. OCI has been added as a section in the income statement. Now, what is this OCI all about? That we'll see later. Don't get worried on that. So we will discuss in detail later, discussed later. So we will discuss with you the concept of other comprehensive income that would be discussed later. Next. So there was a concept of extraordinary item. There was a concept of extraordinary item. So I'll not get into what is that extraordinary item. You've done it at intermediate. So this was what you did as per accounting standard 5. But if you look at the division 2, the concept of extraordinary item is deleted. The concept of extraordinary item. The concept of extraordinary item does not exist. So underline the word not, it does not exist. No longer it is there in the Ind AS concept. Next, we are looking at the third key difference. So as per accounting standard 24, we used to call it as discontinuing. We used to call it as discontinuing operations. And in terms of Ind AS, the number is Ind AS 105. The terminology is undergone a change. We don't call it as discontinuing. We call it as discontinued. So we call it as discontinued operations. So change in terms of terminology. The focus is ED and the focus is ING. So we can say there is a change in wordings. We'll not get into why the change is there in wordings, but you can see the change in terms of wordings. Wow. Okay, so that gives me the key changes in terms of income statement. Now we're going to a little dive in terms of the income statement with you. Okay, so far so good. I think you've taken a note on this. Let's go back to the income statement. So we are going to see a few things. I'm just going to give you a basic overview. We're not getting into details on the income statement. Now watch me carefully. The income statement is divided in terms of two sections, though they're running with each other. A profit and loss and other comprehensive income. Watch this. This is all profit and loss. Till the point number 13, we've got a profit or loss. And in terms of point number 14, we've got other comprehensive income. So your income statement is now comprising of two sections. One is profit and loss and the other is OCI. What is OCI? Don't get worried. We'll see that later. So let's focus first of all on the first section, that is profit and loss. Trust me, if you start looking at all these items till almost, I would say, point number 10, everything is absolutely similar to division 1. Everything is absolutely similar in terms of division 1. Now you said, sir, you can do a little technical discussions. So I am interested in doing a certain technical discussions with you. Watch this carefully. Conceptually, you need to be clear. So before we come to this, let me do some technical inputs with you. Watch this. I am going to give you an example. Please watch this carefully. And we're going to look back and relate this to the format as well. So let's have a look. So thank you for the wonderful session. Your class is much energetic for us in the morning. Thank you for teaching. Thank you indeed. And I will watch recording office time. Okay, I can see some people have got office time now, so I can understand that you need to attend office. That's perfectly okay. Thank you very much for the inputs. Okay. Now, I'm going to take a very simple example. Please watch this carefully because this is a very important correct, because sometimes people do some mistakes, and as you're going to go on to the other Ind AS, you need to connect this as well. Let's say there is a company XYZ and it is into two kinds of businesses. Let's say FMCG and let's say electronics. The company is into two kinds of business. One is FMCG and one is electronics. We're keeping it simple. So the company records its revenue, and they record the revenue in terms of FMCG and in terms of electronics. So when it is going to reflect the revenue on the face of the income statement, they will add the two elements. They will add the revenue coming from both the businesses. So let's say the FMCG gives them a revenue of 1,000, and let's say the electronic gives them a revenue of 800. So these figures are all, let's say, in lakhs. Now, going further, let's say we are reducing the expenses, and when we reduce the expenses, let's say the expenses from the FMCG is to the extent of 600, and let's say the expenses from the electronic is supposed to be 1,000. So let's say these are the expenses for the two electronics and the FMCG. So I am going to get the profits. And when I look at the profits, this works out at 400 if I just want to see individually. And this comes to a loss of 200. So overall, there is a profit to the extent of 200. This is a very simple example to give you a flavor of the inputs. Now, the moment a company meets the parameters of Ind AS 105, hear the words carefully. The moment a company meets the parameters of Ind AS 105, that means, in simple words, they have decided that the electronic division is going to be called as a discontinued operation. The moment the company meets the parameters, what are the parameters that you're going to see in terms of Ind AS 105? But the company decided that I am planning to discontinue my electronic division. So it's classified, let's say, as a discontinued operation. Now let's see how the income statement would look like. When you go to consider the revenue, you will consider only FMCG. You are not going to consider electronics. Since it has been called as a discontinued operations, I will not show the revenue of the electronics division out here. So I'm going to consider the revenue to be 1,000. And from this, I'm going to reduce the expense, and the expenses of the FMCG is 600. So we get a profit which is 400. And this profit which we get is going to be called as CO. That's called continuing operations. So we're going to get the profit which is called CO, that is called continuing operation, because you're planning to continue the FMCG. And we are going to consider what is the loss from a DO, and the loss from the DO is supposed to be negative 200, and you're going to represent the net figure as 200. Which of course matches with the figure out here. It's just a presentation change. It's just a presentation change. And you're going to say that this is the total profit from TO, that's called total operation. So we have reflected what is continuing operations, what is discontinued operations, and what is a total operations. You used to do something similar in terms of division 1 as well. But why did I give you this example? Because I wanted to give you a clarification at this stage. Let me put a very simple questions to all of you. So when you say that this is the revenue from operation, is it CO or is it CO plus DO? Think. When you say it is revenue from operations, which operation? CO plus DO or just CO? And I think you can definitely answer, that's right. It is coming from the continuing operations only. That is one input. Don't worry, notes will come later. So this is what we call the operations, which is continuing. Now, what is operations? Let's also understand that what is operations. Let's, I think, give you the insight in terms of revenue versus income distinction as well. So let's, I think, illustrate the concept of income versus revenue as well. If you look at the first equation, and by the way, let me also ask you, rather tell you, that when you're looking at the expenses, even these expenses are from a continuing operations only. And that is the reason when you're going to calculate the profit or loss, you'll get the continuing operations separately, and you're going to get the discontinued operations separately, and you're going to get the total later on. Great. So let me now first illustrate the concept of revenue as well as the concept of income. When you say revenue, revenue means what comes from business operations. Revenue means what comes from your business operations. That means what do you get from sale of goods? What do you get from rendering of services? So when I say business operation, what do you get from sale of goods? What do you get from rendering of services? Your main operations. Your main operations. So rendering of services, sale of goods, that is supposed to be revenue. Now, when you say it is other income, when you say it is other income, it is supposed to be something which is not business operation. It is something which is not your business operations, but it is supposed to be other income which you're getting from other sources. For example, my company, for example, is sale of garments. So what is revenue for me? Sale of garments. But let's say I'm getting a rental income, I'm getting an interest income, then what is that for me? Other income. So the question which comes into mind is, let me put it like this. When you look at the other income, this other income is coming from what? Can I say it is non-operations? It is coming from non-operations. So this is, of course, the word operations, and this is other income coming from non-operation. So revenue means what comes from sale of goods, rendering of services, and when you say other income, it is non-operation. You sell a machinery. I'm not in the business of selling machine. I'm a garment dealer. If I'm a garment dealer and I'm going to sell machines, can I say if you get a profit on sale of that machine, that is what non-operations for me, it becomes other income for me. Okay, I'm not touching these expense. This is almost, you can say, absolutely similar to division 1. So I'm not coming to that part. This is similar to division 1 itself. That's the basic understanding. Okay, so far so good. Now we can see that the other items are same. The concept of exceptional item is same. The concept of tax expense, everything is largely the same. Let's go further. Okay, then it says the profits from discontinued operations as well, and you get a profit loss for the period. Is this the sum total of CO plus DO? Yes, it is supposed to be CO plus DO. Let me now organize something, but I have a small little question based on your knowledge at the intermediate level. I think testing time before we document some notes on the P&L. Now let me go back. My question now is very simple. When you consider this total income, is it all the incomes or is it before exceptional item of income? Please mind the words carefully. When you look at the total income and when you look at the total expense, is it including all the incomes, all the expense, or excluding the exceptional items of income and expense? What do you say? And that's right, because this is before exceptional item. You are going to take this exceptional item later on, add or reduce as the case may be. So your expenses and your revenues, incomes, they're excluding both. So let me now put this in together. When I consider the total income, is it CO plus DO? Only CO. When you take the total income, is it including all income? It is excluding exceptional item of income. So your total income excludes two things, DO and as well as exceptional item. When you consider the total expenses, then the total expenses is what? Excluding DO and excluding any exceptional item of expense. I hope I'm very clear. So your total income is only CO, not DO, leaving exceptional. Your total expenses again CO, not DO, and leaving exceptional item. And of course, it's before tax, that's implied. So let's make some notes at this stage. Let's get back and let's make some short notes what we started with. I gave you the key changes. Okay, I'm yet to add something out here. So let me just add some notes out here. So you can start writing with me. So we are now looking at the income statement. We are now looking at the key components in terms of income statement. Then I'll give you some inputs on the operating cycle. I will be discussing the concept of OCI in a good detail in the next session. So let's go to the income statement. The income statement has got two components. So you can say that income statement has got basically, you can say, two sections. Running, of course. One is, you can say, profit and loss account, profit and loss. And the other section is what we call other comprehensive income. We have not discussed what is other comprehensive income. We are keeping it pending. So this is called OCI because we need a very good framework to understand the concept of OCI. So we'll do that discussion. Now, as far as the profit and loss is concerned, let's focus on the profit and loss. So you are considering your total income. And this total income, we can say, is excluding. This total income is excluding, number one, discontinued operations, and it is excluding, you can say, exceptional item of income. So this is one key focus, what you need to keep in mind. And from this, you reduce the total expenses. And when you're considering the total expenses, the same concept applies out here. This is excluding a discontinued operations and exceptional item. And then once you get this figure, this is what you call as a profit before exceptional item and tax. Before exceptional item and tax. And then you are going to make a plus or a minus. You're going to consider a plus or a minus as the case may be. As far as exceptional item is concerned, it could be income, it could be expense, whatever the case might be. And then you're also going to reduce the tax expense. So these are the two key focus points. And then you're going to get the profits from CO, that is continuing operations. I'm just going to continue this. So once you get the profits from CO, you also get a DO, and you're going to get the profits from the total operations as well. That's how the basic structure of the income statement is there. Total income, total expense, leaving exceptional and DO, and then you take exceptional tax, and that's the basic structure of the P&L. So as far as other comprehensive income is concerned, discussed later. We're not discussing this. This is technical. So this is going to be discussed later. Okay. So let me know if you're done. We'll go to the next area of discussion. So where is the impact of tax to be shown? Well, I am intentionally not discussing any taxation impacts at this stage. You will learn the taxation impacts in detail when you come to Ind AS 12. This is only giving you a broader structure. But yes, I've given the tax expense out here. This is the tax impact what you've taken. I've not shown the tax impact on the discontinued operations that you will learn in 105. Okay. Now, friends, I think it's time to take you to the concept of an operating cycle. So we are now going to discuss a bit on the operating cycle concept with you. So let's keep it lighter. So we've been discussing since morning the impact of balance sheet, assets being current, non-current, liabilities being current and non-current. And we said everything depends upon the operating cycle of the business. So I think it's time to give you some connect in terms of the operating cycle. We'll do some few illustrations also with you, which is given in the study mat on the operating cycle, because this will also help us to understand the distinction in terms of current and non-current. So let's begin. So I'm just going to give you a recap of what you already know. So I'm going to make a cycle, rather a circle. So you can see that circle out here. Wow, not bad. Artificial intelligence doing the job for me. So it's a perfect circle which I have created with the help of AI. Okay, let's now begin. I went to a supplier to buy raw material, and the supplier gave me a credit, let us say to the extent of 4 months. So my supplier gave me a credit for, let's say, 4 months. I bought the raw material on a credit. He gave me a 4 months period. Now with this raw material, I'm going to translate this into WIP and then translate this into finished goods. So the raw material is going to be converted in terms of WIP, work in progress, and then it is going to be translated in terms of finished goods. This entire process of conversion of raw material into WIP as well as finished goods, let's say, takes a total period of, let's say, 3 months. So we're going to consider, let's say, a total of 3 months to convert this raw material into a finished goods. Now, after the conversion is done, you need to locate a customer, and the goods were lying in the godown, let's say for another 1 month before you located a customer and you made a sale to the customer. So the goods were finished and they were still in the godown. My sales and marketing people spent, let's say, around a 1 month span in order to locate a customer as well. And once the customer is located, he also said, I want a credit. So I gave a credit to the customer, let's say a period of 3 months to pay. I said, okay, I'm going to give you a 3 months period to pay, after which he gives me cash. And then this cash is utilized in the business to pay the supplier, and the cycle goes on. You're all aware in terms of financial management, what is the concept of operating cycle, or what people also call this as a cash conversion cycle. Now, I want your basic inputs at this stage. Can you tell me what is the number of months I will complete this cycle? What is the number of months I'm going to complete this cycle? 4 months is given by the supplier. 3 months I took to manufacture the inventory. 1 month I took to locate a customer. I gave a 3 months credit before he paid me money. So what is the total period of my cash conversion cycle, the operating cycle in this case? So I'm getting 11 months from your side. Let me start counting. If I were to consider the inventory, period, and if I were to consider my debtors period, and if I were to consider my creditors period, so I'm going to look at 3 elements in this case. I'm going to look at the inventory period. I'm going to look at the debt collection period. I'm going to look at the creditors payment period and have a look at the cycle. So let's begin. So we can say this 4 months is what is the payment to the supplier. So 4 months is what the supplier gives me to pay. It's called a creditor's payment period, what you also call a creditor's velocity. Then we can say another 1 month, 3 months, the time is taken to manufacture, and 1 month in order to locate a customer. So I would put it as 3 plus 1 is the inventory holding, the inventory manufacturing period, as well as the inventory holding period. So this is a total of 4 months in this case. Then the customer, the debtor, is given another 3 months, that is a debt collection period. So we can see that if you add all this, it comes to 11, and many people are saying it's 11. But let me first tell you, you cannot be adding this, you need to reduce this. These are the cycle of the current assets, and this is the cycle of the current liability. So you cannot add all the elements. You need to add the elements of the current assets and reduce the element of the current liability. So this is going to be 4 plus 3, 7, 7 minus 4. It comes to a net cycle, which is supposed to be 3 months. But the concept of operating cycle for Ind AS 1 and for division number 2 is not based on the net cycle. We work on the concept of what is called a gross cycle. So if I just take this sum total 4 plus 3, it is 7. This is going to be called as the operating cycle period for the purposes of Ind AS 1 and Schedule 3 division 2. So there are two concepts in terms of operating cycle. Let me put this once again. Hear me carefully. If somebody were to ask me, how do you calculate a working cycle, working capital cycle in terms of financial management? And somebody were to tell me, how do you calculate a working capital cycle or an operating cycle for financial statements in days? I'll say there is a little distinction. First of all, you need to understand the larger picture, that how do you calculate an operating cycle for financial management? It depends upon 3 components. It depends upon 3 components. One is called inventory holding period. The other one is called a debt collection period, and the other one is called a creditor's payment period. If you remember, your ratio analysis used to have activity ratios. And in those activity ratios, you used to connect the dots in terms of stock velocity, debtor's velocity, and a creditor's velocity. That was nothing but the inventory holding period, the debt collection period, and the creditor's payment period. So what we used to do, the 3 components, the inventory or the stock holding period is a current asset add. The debt collection period is a current asset add. The creditor's payment period is a liability, current liability minus. So we used to add the 2 components, inventory and debtors, and reduce the creditors and get a net cycle. That is for financial management. But in terms of looking at Ind AS, or in terms of looking at Division 2, Schedule 3, you will only consider 2 elements, inventory holding as well as a debt collection. No subtraction in terms of the creditor's payment period. I hope you got the picture. So let me put it out here. Let's put it out here. So when we are looking at the concept of operating cycle, you can note it down. So the concept of operating cycle in this case can be in terms of gross and can be in terms of net. So when you consider the concept of net cycle, the net cycle is addition of inventory holding plus an addition of debtors collection and minus the payment of creditors payment period, and you get a net cycle in this case. This net cycle is used in financial management, not in accounts. This is used in financial management. And when you look at the concept of gross cycle, you just add inventory and you just add the debtors, and there is no subtraction in terms of creditors. You get a gross cycle, and this is what we follow in the Indian accounting standard as well as in terms of Division 2. So when you're going to consider the concept of operating cycle, you need to consider the concept of a gross cycle in terms of things. Just add inventory period just at the debtors period, no subtraction in terms of the creditors payment period. I hope you got the picture of the cash conversion cycle. Testing time. I think now it's time to do some questions based on this. There are a few questions which are given in the study material, which I want to look at now. So I'm a bit confused why the credit period is not being deducted. Well, the concept of operating cycle, which was given in terms of current assets and current liability, is based on only what you take. But if you look at financial management, you're looking in terms of what is the period you take minus the period you get. So when you're looking at what is the total time spent will not include what you get from people. So in terms of business, I need to consider that what is the time taken only, not what you get from others. So let's not take the reduction. This reduction of net period is done in order to arrive at the profitability of the businesses, which you're going to learn more in finance when you do financial management or when you're going to do AFM. So in this particular case, the entire concept was based on the period taken. So what is the time taken to hold to manufacture? What is the time taken to collect the money? So they worked on simply time taken, not less what is received, right? So in module, examples of creditors period has been deducted. Why? No worry, we'll just come to you. Just have a look. So let's have a look at the operating cycle in this particular case as well. So let's have a look out here. I am taking you to the illustration number 5. So let's have a look at the illustration 5C. Is the visibility clear enough? You can see the inputs clear enough? Okay, let's have a look now. Let's read what is given out here. I'm looking at illustration number 5. X provides you the following information. I am given the raw material holding period. I am given the WIP holding period. I'm given the finished goods holding period. I'm given the debtors collection period. So let's see what is the operating cycle. Am I going to add all these components? The inventory, raw material, WIP, FG, and debt collection? Yes. So add all this up. This is 3 plus 1, 4. 4 plus 10 is 14. So the answer becomes 14 months. Just add up all these elements and you get the operating cycle. Simple. Let's go to the next illustration, that is illustration 6. So let me now first ask you, if your operating cycle is 14 months and you are going to collect your debtors in 13 months, are you going to consider that as current or non-current? Undoubtedly current. One thing which I want to make a statement which many people at times gets confused, and I would like to make a statement. Can I say debtors and inventory will always be current in nature because debt collection period goes in the calculation of the cycle. Inventory holding period goes in the calculation of the cycle. So can I make a strong statement? Your debtors will be always current in nature because they will be well contained in the operating cycle period. Your inventory is always going to be current in nature because it is well contained in the operating cycle period. Am I right? Absolutely. Let's look at illustration 6. It says inventory or trade receivables of X normally realized in 15 months. Is that the operating cycle? Inventory or trade receivables are realized in 15 months. How should X classify such inventory or trade receivables, current or non-current, if they're expected to be realized in 15 months? Undoubtedly current. As I said, your inventory, that is stock, 100% current in nature. Inventory can never be non-current in nature. And when you look at trade receivables, I would also put it as not 100% to be on a safe side. I'll say yes, they will also be current in nature indeed. Okay, so as per accounting statement, it's right, but as per finance, can't say. Yes, you're right. Finance is different. Financial management would take a different turn, but in terms of accounting, this is correct. Okay, let's go to the illustration number 7 as well. It says B produces aircraft. The length of time between the first purchasing raw material to make the aircrafts and the date the company completes the production is supposed to be 9 months. So it says the length of time you bought a raw material and you completed the production. I guess this can be called as inventory period. You're converting the raw material into a finished goods. That's inventory period. The company receives a payment for a period of 7 months. So what is this 7 months? It's a debt collection period. So you're given the inventory and you're given a debt collection period. What is the length of the operating cycle? Undoubtedly 9 plus 7, it comes to 16 months. And then again, the same question is put across. It says, how would you treat the inventory and the debtors? Undoubtedly, they will be treated as current in nature. What goes in the calculation of the operating cycle undoubtedly will always be current. So if you're considering the inventory period, it has to be current. If you're considering the debt collection period, it is going to be current. Okay. So assuming that inventory and debtors are realized in 16 months, both are supposed to be shown as current. We'll talk more of this. We'll talk more of this when we come to a little more inputs in terms of Ind AS 1 regarding what is, the segregation of current assets, current liability, non-current assets and liability. We'll see that in detail. But this was basic illustrations 5, 6, 7. Okay, this is the only illustrations which are given on the operating cycle concept. I am not taking the further discussions at the moment. Okay, so this is done. Let's, I think, answer that question as well. Somebody said, sir, in the module, somebody said, sir, in the module, they've taken reduction of liability. Let me clarify. Let me do an illustration number 9 for you. So that clarity comes in. I think this should be visible. Yes, it should be visible. Let's, I think, consolidate the input. So after this illustration, we'll just do a quick consolidations of the learning today. Let's have a look at illustration number 9. XY provides you with the following information: the raw material holding period, the WIP holding period, the finished goods holding period, the debtors collection period. The trade payables are paid in 12.5 months. Should they be classified as current or non-current in nature? Let's first add up this period. Let's add up all this, the inventory and the debt collection. So I think it comes to 4 plus 10. It comes to a total of 14 months. That is the operating cycle for my purposes. Now, it says the operating cycle is 14 months. And is this 12.5 within a period of 14 months? Yes. Since the trade payables are expected to be settled within the operating cycle, they should be classified as current in nature. I don't know, somebody said, I have seen, so they're reducing the current liability. Where are they reducing the current liabilities in any case? When you do financial management and you're working at the cycle, it's net. But when you're doing the Schedule 3 Division 2, it is supposed to be on a gross. We'll just take inventory, we'll just take debtors, no reduction in terms of creditors. Got my point? What if the creditors are paid after 14 months? We'll do a little more extensive discussions on the current assets, current liability, once we tell you the inner details of Ind AS 1. As of now, because there is more to tell you about the debtors as well. There is, I think, if I rightly remember, para number 62, para number 69, a few things we're going to discuss in the next session in detail. Okay, so let's now consolidate the picture. Now, what we are going to do in the next sessions with you, before I consolidate the picture, one is I'm going to do extensive discussions on other comprehensive income. You cannot afford to miss the next class. And is the next class going to be a slightly more technical than today? Maybe, or you can call it interesting rather than calling it as technical. And second, we'll give you more insights on how the Ind AS has given us the segregation of current assets and current liability. And there are certain special clarifications which are given in the standard as far as the financial liabilities are concerned. So we need to look at those particular inputs as well. All that is going to happen in the next session. But I think time now to do a little consolidation. Relax your minds. In the next 5-7 minutes, I'm just going to do a quick consolidations of the concepts with you. So just relax your minds. You don't need to write anything as of now. Misinterpretation on my part, that's okay. So do we need any disclosure in the financial statement if the cycle is more than 12 months? We are going to discuss that in the next session as well. So that part which I said, where the cycle is more than 12 months, yes, there are. So we'll see that in the next session. That's what my agendas would going to be. Okay, let's now consolidate. Relax your minds and please hear me carefully for the next 5-7 minutes as I consolidate the learnings for you. So what did we learn today? We basically looked at Ind AS 1 blended with Schedule 3, Division 2. Our focus was to look at the balance sheet. Our focus was to look at the accompanying document called SOKI, and our focus was in terms of looking at the income statement. Now, coming to the key changes in terms of balance sheet, what do you need to do? The starting point in terms of Division 1 is equity liability. But the starting point in terms of Ind AS is assets, though it doesn't make a difference. But you are going to show the assets first, followed by the liability, because you've been used to presenting balance sheets where you start with equity liability. Now you need to get used to the fact that you need to start with the assets. Second, when you present the equity section in the balance sheet, you used to call it as a share capital. Now you're going to call it as an equity share capital. The changes are the preference share capital, 99% is not going to be an equity, but it's going to become a liability in the balance sheet. And number 3, what you used to call as reserve and surplus is now being called as other equity. Let's connect the dots. When you look at the other equity, it is elaborated by a document which is supposed to be Part B of SOKI. And this Part B of SOKI, as I gave you, has got 3 elements with me. It has got a tab 1, which is called equity component of CFI. There is a tab number 2, which is reserve and surplus, which is similar to the Division 1 concept. And there is a tab number 3, which is OCI. We have not yet learned OCI, so we'll be talking of that tab 3 in detail in the next session. And as far as tab 1 is concerned, you're going to learn the concept in Ind AS 32. When you come to financial instruments, you're going to see what is there in tab 1. Great. So this was the key changes in terms of the balance sheet aspect. Then in terms of the balance sheet, I gave you the larger picture that when you look at the asset side of the balance sheet, typically in terms of the non-current assets, the game is 2323. And when you look at the concept of 2323, you can say, number 1, it's non-current and current. Number 2, the non-current is actual, notional, as well as residuary. Notional asset only 1, DDA. The actual assets segregated in terms of 2, financial, non-financial. Contractual right, financial, non-contractual, it's non-financial. In the assets, non-financial comes first, financial comes later. In the liability, financial comes first and non-financial comes later. And then the non-financials is tangible, intangible, as well as biological. I give you exposure on what is a biological assets as well. These are living animals and plants, and all the biological assets other than bearer plant gets fitted out there. The bearer plant goes in PPE. So that was on the non-current assets part. Then as far as the current assets are concerned, we had 4 components, and one is non-financial, inventory, followed by financial. Then there is a tax related, advanced tax, for example, and there is residuary. So 4 elements in the current assets. Then we went on to the liability side of the balance sheet. And in terms of the liability side, we've understood the deferred tax. So when we looked at the equity, we said that equity has got 2, equity share capital and other equity. And if you want the movements, you need to look at SOKI. For equity share capital, SOKI part A, and for other equity, SOKI part number B, which is already said divided in a 3-tab position. Then we looked at the liability side of the balance sheet, and we said the larger picture is same, current and non-current. Non-current liabilities in 4 parts and current liability also in terms of 4 parts. The non-current liabilities are divided in terms of actual, notional, residuary. Actual is first financial, then non-financial, unlike the assets. Here also it is financial, then it is residuary, then it is tax non-financial, and then it is the current tax, that is a tax-related liability. That was on the balance sheet front. Then we went on to the income statement front as well. So all these notes will be shared to you. No worry. So you can go to get all the connects out here. The key changes we saw in terms of income statement, again, 3. Number 1, we said that there is no concept of OCI, a new concept OCI introduced. There is extraordinary item deleted from the Ind AS, and there is a change in terminology, DO, that was called discontinuing as per AS 24. Now it's called discontinued as per Ind AS 105. Then I gave you in terms of the income statement that there are 2 sections involved. One is the profit and loss and one is OCI. We'll be discussing this OCI in good detail in the next session. So that's going to be very important because this is something new for you all. In the income statement, we made a distinction between revenue and income, and we said income is wider as compared to revenue. So when you take the total incomes and expense, you leave exceptional items of income expense, you leave a discontinued operations, and then you consider the impact of exceptional and tax, and you segregate what is the profit from CO, from DO, as well as the total operations. And finally, I gave you the concept of an operating cycle, and we said that you need to follow the concept of gross cycle. You need to add the inventory period, you need to add the debt collection period, but you're not going to subtract the creditors payment period. In Schedule 3, in Ind AS, we follow the gross cycle concept. And we looked at a few illustrations on that. So far, so good. Okay, so that is, I think, the end of the journey. I think I've given you the insights in terms of Ind AS 1. I think that seems to be quite good for the day. But what you need to do, friends, you need to go and revise all this. And if the need be, which you might feel, watch the video again on the YouTube. You have the things recorded again for free access. So do watch it and get your concepts clear. Next session, we're going to work more on the concept of operating cycle, rather current, non-current distinctions, and on the concept of OCI, where we'll also connect a little more dots in terms of SOKI. So over to you for any questions coming on your side. Otherwise, I think we're done for the day. So are you going to teach us all the topics of FR or not? Well, I'm not going to take all the topics of FR. You're going to get more faculties coming in to teach you more topics as well. So thank you, sir, for such an understandable and mistake correction lecture. Thank you. That's wonderful indeed. So thanks for the detailed charts and explanations. Thank you very much on that. That I think is great. So we'll be giving you some more interesting charts and all, some more condensed notes. For these notes and all, you can access the LMS of ICAI, the Board of Studies, where you'll get all these notes which are downloadable. Thank you. Great session. Thank you. Wonderful indeed. And so thank you for a valuable class. Try to attend the classes daily. That's great. Thank you, all of you. So it's time to bid you goodbye, friends. See you on Saturday for another interesting, very interesting lecture. Bye-bye and take care. Thank you. Thank you.